ServiceNow and UiPath are trying to solve a similar problem for enterprises, and that is how to automate certain processes so that employees can be more productive. But which of these two is the better stock to buy? That's the question I'm going to answer in this video. I'm going to compare ServiceNow and UiPath on revenue growth, on cash flow from operations, on returns of investor capital, and then I'm going to share with you my proprietary discounted cash flow valuations that calculate a fair value for ServiceNow and UiPath shares. I'll also look at valuation on a forward price to earnings perspective to get more comprehensive coverage on the valuation metric, which I consider as the most important metric in my 6-step framework for evaluating stocks.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So on revenue growth, they've both increased revenue significantly since 2019. Let's start with ServiceNow, which grew its revenue from $3.5 billion up to $11.5 billion in that time, which is good for a compound annual growth rate of over 25%. Meanwhile, UiPath started from a much smaller base at $300 million in revenue, but increased that faster than ServiceNow, growing to $1.4 billion in revenue in the most recently reported annual completed period. That was good for a compound annual growth rate of 33.5%. That being said, I expect over the next 3 years, ServiceNow will grow its revenue much faster than UiPath. I think ServiceNow will grow its revenue at a compound annual growth rate of over 20%, while UiPath would be fortunate if it grew its revenue at a compound annual growth rate above 10% over the next 3 years. It's not having as much success signing up new customers, increasing engagement from existing customers as ServiceNow has been. And so as an investor, you can reasonably come to the conclusion that ServiceNow has the better product offering in the market for customers, and they deliver a better customer value proposition than UiPath. And you can see that in evidence as revenue growth in recent quarters, which has been faster than UiPath, and in increases in billings, increases in remaining performance obligations. So all of that is evidence that ServiceNow likely has the better product in the market, and that's one of the reasons I expect it will grow revenue faster than UiPath, which I think will grow revenue reasonably over these next 3, 4, 5 years, because spending on this category is increasing robustly. Businesses want to automate as many processes as possible. They want to make each individual employee more productive and thereby more profitable for the company. And wages are increasing. The amount of qualified professionals that businesses can hire is shrinking because of relatively record low unemployment rates, rising inflation. And so this technology is highly sought after from enterprises. And I think that'll continue for at least the next 3 years. The returns on investor capital have been improving for ServiceNow from 2.7% to 7.2%, almost tripling. And I wouldn't be surprised if it doubles over the next 3 years to up over 14% in returns on investor capital. UiPath is making faster progress, but its number is still negative and lower than ServiceNow at negative 13%, but it was negative 103%. So it's making progress and still scaling from its early investment. Remember, the total revenue so much larger for ServiceNow than UiPath. And so it still needs to scale its initial investments, needs to scale its fixed expenses. And as revenue grows over these next 3 years, which I expect it will grow over these next 3 years. I wouldn't be surprised if its ROIC turns positive over the next 3 years. Similar story with operating cash flow. ServiceNow with the better number, but UiPath with the better trend line improvement. ServiceNow at 40% operating cash flow to sales, really good number. One of the best numbers of any of the 200 to 300 companies I'm following. But that's up only 5% from 35.7 in 2019. UiPath, meanwhile, at 22.4% is about half that of ServiceNow, but that's up from, let's say, 4.8% in 2020. So that's a more than 4x improvement on the OCF to sales ratio. Similar story to ROIC, right? ServiceNow is better, but UiPath is making better progress. Looking ahead, actually, I don't think UiPath will continue making better progress than ServiceNow. I think their progress might be similar over these next few years, similar improvement in their metrics, whereas the previous few years, UiPath has had better improvement, while ServiceNow has had the better number. So now let's look at my proprietary valuations here. The intrinsic value of the ServiceNow stock I calculated is $923. Current market price $1,007. Looks fairly valued when I account for my margin of safety. For UiPath, intrinsic value per share of $17. Current market price of $12.40. Looks significantly undervalued even after accounting for my margin of safety. This stock looks undervalued when measuring by my discounted cash flow valuation model. And let me return to the charts. And I'm getting all these charts from finchat.io. There's a link in the description for a discount if you use my link. Looking at the forward price to earnings ratio, ServiceNow more than twice as expensive as UiPath at 58 compared to 23 for UiPath. ServiceNow, if they were trading at the same price, I would pick ServiceNow. No question. Clear leader, better on nearly every metric except trend line improvement, which I expect to be equal over the next few years. No brainer, I would pick ServiceNow if they were trading at the same price. Even if ServiceNow was trading at a forward PE of 30, 35, maybe even 40, I would have picked ServiceNow as the better stock. But it's trading at a forward PE of 58 compared to 22. So I think the premium is overstated against UiPath right now. So if I had to pick between these two, I would pick UiPath, most notably because of the better valuation. Everything else favors ServiceNow, but valuation favors UiPath significantly, and that sways my decision to UiPath among this head-to-head comparison. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.